Hello, best of listeners, and welcome back to another edition of the Actively Passive Investing Show. As always, I am your co-host, Theo Hicks, with Travis Watts. Travis, how you doing?
Hey, Theo, doing great.
Great. Well, thank you again for joining us today. Best of listeners, thank you for joining us as well. And today we're going to give you a case for multifamily real estate in 2021. There's a question mark in the title, but for me, it's an exclamation point. The case for multifamily real estate in 2021. So we're gonna, Travis and I have done a few actually passive investing shows in the past on different, very detailed, in-depth, well-researched multifamily reports, commercial real estate reports, going over a lot of stats and data on specifically why multifamily is there's a strong demand for multifamily, some of the forecasts for commercial real estate in general, but also multifamily for 2021 and beyond. And so based off of kind of our backgrounds, as well as our reading of those reports, we kind of threw together a list of different points that support multifamily, investing in multifamily specifically in 2021 and really and beyond. And a lot of these metrics will kind of give you an idea of what types of metrics indicate a demand for multifamily, right? What types of metrics show that a certain asset class is going to be strong? How do you know that a certain asset class is going to be strong? So those are the things we're going to talk about today. We're gonna keep it pretty high level. If you want to check out some more detailed analysis, again, check out some of our other actively passive investing show. And there's also lots of different really solid real estate reports out there that you can find as well.
Absolutely, Theo. I think for me anyway, the purpose of this particular show episode is that, to your point, we're usually going really in depth on something very specific. What are the top 10 markets for 2021, or how does a cap rate work, or whatever it is. But this is just the way I envision this. Is I'm sitting at a table, I'm introduced to somebody I don't know. They say, "What do you do?" And I say, "I invest in apartments." And they say, "Oh, really? Tell me more. Why would you do that?" And so this is just kind of that high level, like, I'm kind of making the case for why I do what I do. And so it's just kind of some general thoughts. So I'll kick it off with something that we talked about several episodes back. I can't remember which one it was, but it's about cash flow strategies. Okay, I'm such a huge advocate for investing in things that produce passive income or cash flow or dividends or interest. And personally, part of my criteria is on a monthly frequency. And the reason is because when I have a whole portfolio stacked up with monthly paying cash flow producing assets, yes, I'm living on a portion of it, but then anything I'm not using, I'm able to quickly reinvest into other assets that produce even more cash flow. And therefore, what's important about that little circle of life right there is the way I see it, I'm reducing my risk. Okay. So let's say I have to go out there in the world and I have to earn an income and I pay my taxes and I'm left with my net amount of cash. Well, I take that cash and I initially put it into some real estate, let's say. So that, in my mind, is where I'm taking the most risk. In fact, all the risk, right? That first investment. But as that investment starts kicking off more cash flow and more income, and I take that and then buy another asset over here, then I'm taking significantly less risk, because even if that new investment that I just made over here falls apart or goes to zero or whatever happens, I still have my initial piece of real estate, right? And so I still, in my mind anyway, I'm sure some people probably don't agree with this, but I really, it's almost like I've taken no risk on the last investment that I made, because I still have everything that I started with, hopefully, and then some. So that's the primary reason. We're going to get into a lot more in this episode, reasons for multifamily and apartments and et cetera. But at the top of my list, it's all about cash flow and passive income. I'll leave it at that.
Yes. So going into one of the first kind of metrics. So let's take a step back first. So like all transactions, it's all about supply and demand, right? And so for real estate, for multifamily, I like looking at the supply as two different things. It's the people and then the properties, right? So people need to live somewhere, and so every person needs a place to live, right? And so how much supply, how many properties, how many units are there for people to live in, right? And so as the number of people go up, if the units stay the same, then demand for those units are going to go up. If the people stay the same, but the units go up, then the demand for those units are going to go down. And when the demand goes up or down, that impacts the amount of rent that could be charged, right? So it's kind of a simple calculation. And so when it comes to determining kind of where supply is at, there's places you can see the number of units constructed, but those are kind of good to understand, kind of comparing to previous years. But I really like the absorption rate. And so that basically tells you over a certain period of time, there's this many available units, what percentage of those units have been occupied, right? And so that doesn't necessarily tell you, how many units are being constructed, but it kind of shows you what the demand is for the units. And so obviously, an increasing absorption rate indicates that there is less units than there are people. If it's going down, then there's more units than there are people. And so when you realize real estate reports, and you probably heard this before, is the affordable housing crisis, right? There's a very limited supply of affordable housing because of the costs to make multifamily, and then the amount of rents you can get, right? And so all the new construction is going to be these A class because it costs a lot to develop a property, and so you need to get a lot of rent in order to cover all those costs. And so it doesn't financially make a lot of sense to do a new development for like a C class or B class property. It's usually be like in the A class range in really nice markets. And so since again the supply of B class, C class affordable housing isn't really going up, it might even be going down because they're getting fixed up and brought to a higher level. But the number of people that need that housing are, especially now, going up because of the current recession that we're in. That is a big plus for multifamily from a supply and demand perspective, and this is kind of reflected in the rent growth. So I just did a blog post a few weeks ago about the rent growth forecast, right? The 10 markets where rents are going to grow the most in 2021. And what you realize when you read these things is that, these are all, again, forecasts, and it could be higher, it could be lower. But when you kind of look at 2020 rent growth and then 2021 forecasted rent growth, they're not in these massive big markets, right? I mean, the market that grew the most in 2020 was Boise, Idaho, of all places, right? And so they're not these A class markets. They're these secondary and tertiary markets. So on the one hand, you can see that there's a lack of affordable housing. There's obviously there's a lack of affordable housing, and then in these areas the rents are going up. And so if you are a passive investor, you might want to consider looking at, again, these value add type plays where they're buying these C class, B class properties in areas that have experienced rent growth that have beat the national averages over the past 5 years, is projected to continue to beat the national average over the next 5 to 10 years. I'm investing in those places, right? You can still do well, investing in new development deals and things like that, but at minimum, right, you're always going to have this demand for these affordable housing until something changes where it becomes really cheap to build again.
Absolutely, Theo. Great points. The two other things I was just thinking about is, so I want to give a different kind of spin on what everybody's pretty familiar with, which is the appreciation aspect of real estate and the depreciation aspect. But I want to take it a step further and paint a different picture. So a lot of people think of appreciation in the sense that, I'm going to buy this property, whatever the property is, single family, multifamily, et cetera, and I'm going to sit on it for numerous years. and hopefully the market's just going to lift the value. And, to your point, supply and demand, and one day it's going to be worth more, right? As we all know, our grandparents and what they paid for their single family homes way back when, right? And $20,000 for a house that today's $500,000. Well, that's certainly one way to look at appreciation. The problem with that is, the markets don't always just go straight up. As you know, what about 2008 and 9 and 10? Sometimes markets go down. So solely relying on just market conditions for appreciation, I think, is a mistake. And this is why I invest in value add properties, because we are forcing the appreciation. We are buying something that's already at a discount because it has some problems. We're fixing those problems. We are raising the rents. The whole name of the game in multifamily is net operating income. So we either have to increase revenues and or cut expenses. And then your NOI, net operating income, goes up, and then your property is more valuable. A lot of single family investors don't necessarily think about it that way, because NOI really is almost irrelevant in the single family space. It's more based around the comps in your area. So that's one thing to think about with appreciation. The good thing about real estate, generally speaking, is that it's kind of an inflation hedge. So, if you believe the Fed in their projections that whatever inflation's 2%, well, then theoretically, your property's going up approximately 2%. Either you can raise your rents 2%, or the cost of materials to build that goes up 2% a year. So yeah, in theory, over time, the property's worth more, but guess what? I mean, it's gotten eaten up too with inflation, right? So maybe it's really not worth anything more. So something to think about there is, think about it like buying a stock. If you could find a really solid company that for whatever reason just had a big dip because the whole market went down, like we saw last year in March and April. So if you're able to pick that stock up at a 30% discount and it recovers, well, now you have a 30% buffer, right? So the market could collapse again 30%. Well, you still wouldn't be losing any money. You'd be kind of at a break even at that point. That's just how I like to invest, and a different way to think about appreciation. Now for depreciation, this is where we get into taxes, and Theo and I certainly aren't CPAs or tax professionals, so certainly seek out your own licensed advice on this. But real estate has some tremendous tax advantages with bonus depreciation, with cost segregation studies that you can do, mostly applicable in the multifamily space. But the bottom line is, to the point of my first topic, when I was talking about reinvesting cash flow and then lowering risk, well, if I'm not having to pay, 35+% in taxes on my cash flow each year because I have more depreciation than I have cash flow, then I'm able to reinvest that cash flow over and over again, where otherwise I wouldn't be able to. And if you ever look at these compound interest charts, I'm sure most of us nerds out there, myself definitely included, are always running these calculations of the phenomenon of compounding. But if you ever throw in the equation of assume that you paid 35% tax, it's incredible. I mean, we're talking over time, millions and millions and millions of dollars in difference just because you were paying taxes along the way. I mean, it's certainly a killer of returns, hands down. So another reason I invest in real estate in general, single family, multifamily, syndications, et cetera, is the tax advantages and the fact that I can keep rolling that forward, and that they're tax favored. I'm holding a property, let's say longer than 12 months. Well, now it becomes a long-term capital gain, which is tax favored, as compared to just getting interest in the bank, for example, something like that, which goes into your ordinary brackets, up to 40% plus, that kind of thing. So those are two more high-level thoughts I just thought of.
Yeah, a quick follow-up on the appreciation. And I think I've brought this up a few times on this show, but I really like this thought process. And it was from the first kind of webinar that we did for the Best Ever Conference, and they're talking about I think it was like should you buy or should you sell or should you hold in 2021? And it was it was a tax, it was like a tax a specialist, and she was saying how like, look, like if something changes in the tax code, like it's going to in a sense impact like all investments like very similarly, right? There might be like some might be impacted more or less, but like everyone's going to kind of be in the same boat, and so it's like, are you just going to stop investing, period, or are you just going to like find the best investment for the time being, right? And I think we did talk about this. We're saying like maybe you won't get 10% returns, but you'll get 5% returns when everything else is going to be zero or negative, right? And so when you're talking about the appreciation, I kind of triggered my thought process because like, look, even if that cap rate part of the equation, right, makes it so that values go down, right? It's probably going to be, it's not like it's real estate value is going to go down and everything else is going to be completely fine. Like the stock market is probably going to go down too. Other investments are going to go down too. And so when you have that other metric of the forced appreciation, right, you can offset, maybe even completely overcome any reductions, any dips in the market by forcing that appreciation up. And then it's even better if you're investing with a company who is very conservative with their underwriting and even assume that, hey, in 5 years from now, we're expecting the market to be worse than it is now. So that if it's not, then the value is appreciated even more. And so we're talking about the case for multifamily, right? And when you're investing in these value add forced appreciation type deals, if the market's doing really well, then you're going to do even better. If the market is not doing very well, then you're going to do better than what you would do if you're investing in something else that was completely reliant on the market that's not doing very well.
Right.
So a couple other points too. So the back end buyers, and so the last week we talked a lot about the exit strategy, right? Who's going to buy the multifamily? And right now, I know Travis has talked about this a lot, but the returns on other investments are either really low or not very stable, right? And so a lot of these big institutions, these big hedge funds, are buying real estate. They're buying stabilized, turnkey, low headache real estate in order to get that 5% return, that consistent return that they can't really get anywhere else. And so when you are investing again with value add, or really investing with anyone who plans on stabilizing the property, which I don't know why they wouldn't stabilize the property, then you can have confidence that on the back end, right, an institution is going to buy this property from them, right? And so a good question. Sorry, go ahead.
Yeah, I was just going to caveat one thing that you mentioned that's critical for everybody listening to understand. When you're saying a 5% return, we're talking about an unlevered return. We're talking about institutional capital buying an apartment community with no debt, no leverage, okay? That's what a cap rate is essentially when you're buying at a 5 cap. So these institutional players, just to clarify your point, Theo, are looking around and saying, well, treasuries are paying whatever, 1%, and bonds are paying 2%. And so, hey, 5% sounds pretty good. And if you're not using any leverage or debt, you're taking a lot less risk. Therefore, this may be pretty comparable to buying a bond or a treasury, right? I mean, at least in my opinion. So that's kind of their perspective from a institutional standpoint, is this is a pretty high yielding asset without taking on a lot of risk if we're not going to lever it up with debt. Sorry, go ahead.
No, exactly. Thank you for clarifying that. So because of that, right? Because there's a demand from these institutions for that type of real estate, then not only can you benefit from kind of what we talked about already, the cash flow, the appreciation, the tax benefits, the capturing the rent growth, demand, limited supply, but you can also have confidence that once it's done to sell this thing, someone's going to buy it, right? Because you might say, oh, well, who's going to buy this thing on the back end if the market's not doing very well, the market takes a dip? Well, if it's going to perform better and be a lower risk than other investments, right? The institutions aren't just going to do nothing and spend their money. They're going to invest in something. And this is going to be one of their better options, especially now. And then from your perspective, right, to even reduce your risk even more, because whenever you do research on some of these, you look at these real estate reports, you'll see that like a national average for everything, and then some things are below, better than the national average. some are less than the national average. And then if you kind of look at, say, 2019 data forecasts, and then what actually happened in 2020, maybe some that were supposed to beat the national average didn't, maybe ones that were not supposed to beat the national average did, right? It's kind of hard to be perfect, especially, in 2020, especially. And so a good way to minimize risk even more is to kind of diversify across multiple markets, right? And so passively invest in some, primary markets, but then also do some tertiary markets, some secondary markets. That way, you might not necessarily do as well if you put all your eggs in one basket and we're right, but you aren't going to do as bad if you, put all of your eggs in one basket and we're wrong. And so diversifying across these different types of markets that have different pros and cons can help you participate in kind of the national average. Hopefully, outperform that. But since you're in multiple places, then if something happens to not perform how it was supposed to, then the ones that did can kind of pull you back up and make sure that again you're keeping your capital and it's growing and you're making that cash flow.
It's part of the beauty of being a limited partner. It's one thing I highly value diversification, and it's a lot of the reason why I left doing single family investing, where I had a portfolio of single family homes, into multifamily, as I could pull that equity out and I could redistribute it in smaller amounts nationwide in markets where I was kind of placing a bet on, with operators who, quite frankly, were doing things a lot better than I was. And so I'm huge on that. Absolutely. We covered the top 10 markets, as you pointed out, in a couple episodes ago. So, in theory, right, I was able to liquidate those single family homes and go put, 25K here and 50K here and 75K there, and spread that across those top 10 markets, give or take. So great points, Theo. Another thing, since we're talking about single family and multifamily, is the safety of your capital. So this is something I got really uncomfortable with. Let's take an example of a single family house rental and multifamily asset, both leveraged, meaning that we have mortgages or debt on them. Let's apples to apples that way. So with a single family home, the ones that I used to own, so when I had a renter in them and I was getting the rent payments on time and in full, I may have been a few $100 cash flow positive every month. But anytime a tenant moved out or didn't pay me rent, not only did I not get the few $100, I went severely negative, because I still had property tax and insurance and HOAs in my mortgage payment, so I might have been $1,000 underwater. So, that 300 just goes away if in month number 5, I don't collect a rent payment for whatever reason, in addition to all the maintenance issues that pop up with roofs and HVAC systems, et cetera. I mean, a lot of times my cash flow was wiped out for the entire year just because of an unforeseen whatever, that kind of thing. So I got to thinking about risk, and I thought, man, if I had 5 properties and even 3 of those, I wasn't getting rent for whatever reason, maybe a flood, a tornado, or just a coincidence, I might be in pretty bad shape. I'd have thousands of dollars per month to cover in expenses, and I certainly didn't have enough cash flow from my other properties to cover that. So in multifamily, let's use a 100-unit apartment building just as an example. A lot of times you can find these and underwrite these properties at, let's call it a 60% break-even occupancy, just to use simple numbers again. That means out of my 100 units, I could have 40 tenants not paying rent or not occupying the units, and I'm still at a break even. I'm not losing money. I'm at a break even on the property in terms of cash flow. So to me, that's really about safety and risk reduction. And it's a big reason I really like multifamily, which is obviously the topic that we're covering here. In addition to the last thing, I know I already covered a little bit, but the inflation hedge of, we can bump rents based on what the inflation rate is. The materials get more expensive to build these types of products. Therefore, our product becomes more valuable. So It's a huge topic right now, Theo and everybody listening. If you haven't been tuning in, I mean, the Fed is just pumping trillions of dollars into the system. We're going to see inflation. I don't know what percentage. I'm not that smart. I don't know how that's really going to pan out. And hopefully it doesn't end up as like hyperinflation, like we've seen in Venezuela or back in Germany in the 20s and 30s or Zimbabwe. But I do think this 2% inflation's perhaps a little bit of a joke looking forward at the next decade. So you want to be in something, in my opinion, that's an inflation hedge. And if you're leveraging, like we're talking about, if you have a mortgage and debt, you are locking in today's dollars in that debt and then paying them off with cheaper dollars. The more we inflate and the purchasing power goes down, the more money we have to pay off that pre-existing debt. So all in all, big fan of real estate in general, but multifamily for those reasons.
Yes. And then kind of close to summarize, I think the point, or the thing to think about here isn't, is multifamily, is me passive investing in multifamily going to help me, double my money in a certain amount of years or get 15% annualized return? I think the better approach is to compare it to everything else, right? And so I kind of said this multiple times in the show, but right, you're gonna, unless you're going to keep your money, in the bank or under your mattress, you're going to invest it in something. And so, what is the best vehicle to invest in? What is the ideal vehicle to invest in? And when the market's doing really well, or when the market is not doing really very well, or when you think the market's not doing very well, or you think it's doing very well. And the point of all these things is to say, hey, like, look, these are all the different things that multifamily has going for it that allows it to obviously perform, really well when the market's doing well. But most things do well. But what happens when it's not performing well? What happens if there's a dip, or as you talk about inflation, or or a recession, the stock market crashes, or whatever? People are going to need a place to live, and you're going to need a place to invest your money. And so, kind of those two things being true, real estate is a very good place to park your money. And then we've also kind of went specifically why we think that multifamily is one of the best places in real estate to park your money, especially when it comes to single family, especially if you're doing if you're passively investing, right? Actively investing is kind of a different story. We're talking about passively investing. What should you passively invest in? And Travis kind of went over specifically his story about single family homes versus multifamily. There's a lot more advantages to that as well. We do have a couple of blog posts comparing single family and multifamily on at joefairless.com. If you just type in SFR versus multifamily on there, that will come up. But that's kind of how I approached this. Is like, look, you got to invest in something. What should you invest in? Multifamily, and here's why.
Yeah, something else to think of. I'm glad that you brought that up about, again, you brought up looking at the surrounding options. So I did an episode on our show a few episodes back, just solo, about, what kinds of things in our market today are yielding approximately a 2% return, or a 4, or a 6, or an 8, or a 10. Just giving examples to think about, not suggesting all of these will and always, produce this kind of cash flow, but it's something to think about. And yeah, I mean, I'm still bullish on multifamily for the reasons we talked about, mostly because institutional capital is looking around saying, well, 1% over here, or 2% over there, or 5% over here. So, and think about this, a lot of people have trouble wrapping their head around where cap rates are today in real estate in general. And let's say nationwide, they're around 5% on average. Well, let's say that they go to 2%. Well, your immediate thought might be, oh, well, I'm out. I'm not doing, if it's a 2 cap, that's crazy. I'm not investing in real estate. Well, what if you look around and the bank is at negative interest rates? You're having to pay the bank to store your money, and bonds are negative. And, what if there's no such thing as yield except for real estate that yields a 2% return? Well, that's probably going to be your best option then, if you're going to want to make any kind of return whatsoever. So you always have to be matching it up against the surrounding options. And But in another scenario, let's say that cap rates are 2% on multifamily, but municipal bonds are 4%, which would be a crazy world, right? But if that were the case, well, maybe that's a better option, to place your capital, because you might get a tax-free yield at a higher interest rate, and these kinds of things. So you always have to be kind of looking at the landscape and understanding what Main Street investors are looking for and chasing, and institutional. And from our last episode, understanding kind of what the exit strategy is. Who are you likely going to be selling to anyway? With single family, that's going to be individuals. That's going to be Main Street people. With a 500 unit apartment building, that's probably going to be an institutional buyer more than likely. So things to think about. Those are my final thoughts.
I like that. Like looking at like what are these big institutions doing, and then assuming that they know what they're doing, right? They have some information that they're basing these decisions on when they're investing, hundreds and billions of dollars. And it kind of reminded me of something we talked about a while back when we're talking about how to kind of analyze the GP's market, right? It's something else that you do as well. It's like, okay, well, if a Fortune 500 company is moving to this market, they have a big team who's analyzing the entire country to say where should we move our corporate headquarters, based off of a variety of different metrics. And so if you've got a bunch of Fortune 500 companies going somewhere, you've got some big Fortune 500 company buying up a bunch of real estate somewhere, something's probably, they're probably onto something, right? And so you can kind of use that as a guide to where to invest, market wise. Same thing here, right? What are the institutions doing? Are they investing in multifamily? Are they investing in bonds? Are they investing in the stock market? What are they doing? And then kind of figuring out why they're making that decision, right? They're doing it. They're not just randomly investing in multifamily. They're doing it for a specific reason. So that's another way to kind of guide you to, where to invest, where to maybe test things out. So yeah, you said anything else you would mention, Travis, before we sign off?
Nope, I think that's it. I mean, all in all, to conclude, I'm still bullish on multifamily for 2021, and looking forward, I'm still investing. I did more deals personally in 2020 than I've ever done in any given year, and we'll see how this year pans out. So, yeah, that's my opinion on it. But for what that's worth, that's all I got.
Perfect. Well, thank you as always, Travis, for joining us today. Best ever listeners, thank you for tuning in. One last thing to mention before we sign off, we are doing a new shorter segment on YouTube. We're calling it the 60-second question. So you submit your actively passive investing questions. If you're watching on YouTube, in the comment section below. If you're listening to the podcast, you can just email me directly, theo@joefairless.com. And Travis and I will read your question and your name, and then we'll answer it in 60 seconds or less. We got a couple videos already up on our YouTube channel, so make sure you check that out. If you want to have your question featured, again, email me, theo@joefairless.com. So again, thank you for tuning in, best ever listeners. Have a best ever day, and we'll talk to you tomorrow.